Now it gives me great pleasure to introduce Dr. Anantha Nageswaran. Dr. Anantha Nageswaran is a writer, author, teacher, and consultant. He writes a weekly column for Mint and co-authored 4 books. He is on the board of few companies of the TBS Group. He is presently the distinguished visiting professor of economics at the Korea University. He is also a honorary senior advisor to the International Financial Services Authority of India. He was a former member of the Economic Advisory Council to the Prime Minister. He earned his doctoral degree from the University of Massachusetts in Amherst in 1994 for his work on exchange rate behavior. He received a postgraduate diploma in management from IIM Ahmedabad. Ladies and gentlemen, Dr. Anantha Nageswaran for the dessert.
Yeah, I'm just setting my clock. Good afternoon, good evening, and thanks to Almus for the opportunity to share my thoughts. Of course, these days, you don't know your own thoughts, how valid and how dated they are after even a few hours. With the speed with which our own views become outdated is probably only second to the speed with which the virus mutates itself. And therefore, I must tell you that this presentation was prepared before this new Greek alphabet, Omicron, came into our lexicon. And some of you, I hope, might have read the article that appeared in the Economic Times today, which is a very sensible article about how to keep this variant in perspective. So you must assume that the bulk of this presentation would hold good if this new variant turns out to be maybe transmissible, but not necessarily highly lethal. So if that is the case, then most of what is being said here would hold good. So with that preamble out of the way, I'm going to share my thoughts. I view the Indian economics or the macroeconomic glass as more than half full. And I'm going to tell you why I think so. But obviously, this is one person's view. And these are my personal views, of course. So first thing, let's go back to the 2018-19 situation when Indian economy was already beginning to slow down and why it happened. The standard narrative or the easier narrative is to sort of blame demonetization, to blame the introduction of GST and the insolvency and bankruptcy code as introducing some structural behavioral change on the part of the private sector, etc. But what is not widely recognized, and this is surprising given the literature that we have throughout the world, that anytime an economy goes through a banking sector crisis with non-performing assets, with both lenders and borrowers becoming risk averse, then such an economy undergoes a fairly longish slowdown and takes longer than usual to recover than it is from a cyclical economic slowdown. And that's what happened to India. It's a classic financial sector induced economic slowdown, which took a long time to digest, as is often the case globally. On top of that, I would like to point out a few things. In the second half of the decade, we also had the collapse of the IL&FS in 2018 at the beginning, and that the monetary policy makers' response was not exactly to recognize the severity of it and supply the economy with abundant liquidity. So in that sense, with respect to IL&FS collapse, I don't think the RBI really played the role of the lender of last resort very well. And this was already compounded in a way by the circular that the RBI had issued in 2018 February in terms of the recognition of non-performing assets and referring those assets for resolution. That had already caused considerable amount of uncertainty. And then on top of that, of course, we had personnel changes in RBI by the end of the year. And the finance minister of India at the time himself was undergoing some serious illness. So there were a lot of policy uncertainties and personnel changes. On top of an ongoing banking system crisis, we had a non-banking financial institution collapsing, which was too big to fail. And that completely choked off the supply of credit to the NBFC. So that is why India had an economic slowdown well in motion before the pandemic struck. And that is why post-pandemic, even the mere removal of these proximate factors should set the stage for a sustained 6% growth rate. Now, whether we cross 6 and go towards 7 and 8 will depend on many other factors, including luck, which is widely understated in the world. But that is where we are. So if you look at the performance of the Indian economy in the first decade in dollar terms, there is so much of nostalgia about what we achieved in the first decade of the new millennium. But let's remember that in the first decade, in 7 out of 10 years, the rupee appreciated against the US dollar, which you can see from the bars below zero. The number of bars below zero, total 7 out of 10. And then in the second decade, only in 2017, did the rupee appreciate against the dollar. Every other year, the rupee depreciated. And that is why the dollar GDP per capita growth rate of the Indian economy in the second decade turned out to be such a big disappointment. And therefore, you have a domestic situation, a financial sector crisis, and the currency basically suffering from the twin deficits and the lax monetary and fiscal policy, contributing to basically a massive depreciation in 2012 and 13. And then subsequently, then the rupee was probably held down by the policy of reserve accumulation as well. So all told, you had the financial system and the rupee depreciation, giving the impression that the Indian economy had a very weak second decade. And that is what you see in these numbers. Nominal and real GDP kept slowing down as we headed into the pandemic. And I think we are now beginning to see some of these very special one-off factors dissipating already. And this slide, you may feel a little bit annoyed at the maze of numbers presented here, but it's effectively the data on consumption and production of petroleum products. What you see here is compared to the previous financial year, the current financial year in the first half, consumption of petroleum products as well as production have increased quite a bit. And we are still somewhat away from 2019-20. But I hope that the second half of the year already, which we are into the third month, I think we will see accelerated growth in the consumption, which is a proxy for mobility and a proxy for economic activity in general. So, and then while we also focus on the rising current account deficit, which probably is running currently at the rate of 3% of GDP, and that's a little bit of a concern. But the good news, on the other hand, is the non-oil, non-gold imports have kept up above the 5-year average in 6 out of the last 7 months, actually speaking. And then if you look at the GST collections, and I haven't had the chance to include the October data that has got released recently, it is probably 13 out of 14 rather than 12 out of 13. So that is also these days turning out to be a pretty decent proxy. So all I'm trying to point out is that the cyclical recovery, save for what will happen to Omicron, etc., is actually developing roots. And we should be heading towards a sustainable, beyond 21-22, a sustainable 6.5% GDP growth. Looking beyond 21-22 and 22-23, I would like to submit the possibility that we may be getting into a mini replay of what happened between 2003 and 2008, and that is basically the credit growth coming back. So we had a fairly stagnant credit to GDP ratio, bank credit to the non-financials, private sector, excluding government, very stagnant all the way into the new millennium, and then a major ramp up from 25% up to 55% of GDP. And that naturally led to indigestion because GDP was rising, bank credit was rising even faster. And that is why we took the entire second decade to digest this. And I think that is out of the way. We have barely got going on the third decade, and it is still early days with the pandemic never really leaving. And I think here we must take into consideration the possibility that internationally there are several players who benefit from the persistence of fear and uncertainty. Whether it is the obvious candidates like the pharma sector or governments clamoring for control and power, or for that matter, asset markets which prefer monetary policy to remain rather accommodative. There are vested interests which continue to sort of keep the fear and uncertainty going. And that could be an important factor to worry about for the world, not just for India, but mainly for Europe. But that aside, I think we should be beginning to see the ramp up of the credit to GDP ratio, bank credit to GDP ratio as we head into the decade. And that is what gives me confidence about the medium term. And then while many of you are familiar with the blocks here, I would like to just point out the last two blocks, while the focus in the last 10 days has been on the repeal of the farm laws, which I think the Prime Minister did keep the door open for its reintroduction at a later stage. Probably a better version and a more consultative version, because many states already have moved in that direction. So it's not as if the privatized farm sector activity isn't a reality already in the country. But more importantly, I would like to draw your attention to the Gati Shakti dashboard, as well as the public procurement rules that the government announced. And these are structural reforms, not of the ones that catch the headlines of the pink papers on the front pages, but more in terms of procedural rigidities being removed. Information asymmetry is being removed with the account aggregator framework, Gati Shakti, and public procurement ensures that the private contractors get paid at least 75% within 10 days of completion of the contract. And this is a new circular that the DOE issued towards the end of October. And I think that will make for a very big change in the relationship between government and private sector services. And therefore, these are the ones that give me more hope than headline economic reforms. The FDI activity in general, in the last 7 years, has been a source of consolation for the Indian economy, given that domestic private sector has been digesting its balance sheet troubles. So we have had a net FDI of more than $30 billion, crossing even 40 billion in the last 2 years. Given whatever is going on with respect to China, etc., I would expect that barring major political shocks in the country, this number to continue to remain high and even become higher, crossing $50 billion on a net basis in the coming years. And in general, if you look at the history of India's FDI, foreign investment flows, it has been dominated by the direct investment flows rather than by portfolio flows. And that's a healthy sign. And I believe that this will continue. And that is one more reason why I am optimistic about the medium-term growth prospects. Last, of course, on this cyclical thing, the National Council for Applied Economic Research came out with the second fiscal quarter survey of business expectations. Not only business confidence has picked up, but even policy confidence has picked up. Of course, this came out before the farm law repeal, but the point remains that by and large, the market is convinced that government, with its announcement of various initiatives, has gotten the economic bull by its horns and will continue to stay the course. Yes, inflation and unemployment are the two of the weaker links when it comes to business sector confidence on policymakers' ability to steer the economy. But I would submit that we should worry less about inflation being an issue, because there is nothing sacrosanct about 4%. And in India, inflation in any case isn't amenable to central bank intervention. It is a supply side problem. As long as government keeps at it in terms of declogging the economy by removing the license inspection compliance Raj, LIC Raj, then I feel India's inflation would come down, productivity would improve. Unemployment is indeed a long-standing issue, but once again, the hope is that once the capital expenditure cycle in the private sector kicks off, which might take a year or two, then the unemployment problem should stop garnering the front page attention as it is happening right now. Because my hope about the Capex cycle rests on this particular slide. This is a bottom-up data coming from the RBI every year. How much is the private sector actually raising resources and to be invested in capital investment? As you can see here, from 2011-12 onwards, it has been coming down. However, before the pandemic struck in 2018-19 and 2019-20, this number, the blue bars, began to rise. And at that time, capacity utilization was still very high. So in spite of that, Capex was beginning to look up. but COVID came. So my hope here is that the low capacity utilization shouldn't be a big consideration. And the reason is there are three fundamental factors that have lined up together. Free cash flow as a percentage of Capex, the corporate tax rate at its lowest, lending rate at its lowest, and free cash flow at its highest. And then secondly, the large cap companies are running at a very high capacity utilization rate. Only the mid and small cap companies are having low capacity utilization. And therefore, once the large companies set the lead in expanding capacity, it should have a knock-on effect in the positive direction. And the large companies have also reduced their leverage quite substantially in the last 3 to 4 years, as you can see on the right-hand side of the panel. The government on its part is definitely helping to maintain the Capex spending in the current financial year. It's more than 35-38% compared to last year, and compared to the pre-COVID year, the government Capex, the central government Capex is up 22.3%. As expected, defense, railways, and roadways are leading the charge. So these are all my reasons for being constructively optimistic, both about the short run and the medium run. However, IMF, by lowering India's dollar GDP forecast, has drawn attention to the lingering inflation concerns. As you can see here, in October 2021, with its World Economic Outlook, the fund indeed lowered India's dollar GDP by 2026. It is now $140 billion lower than what the fund projected way back in April 2021. And this is in contrast to what the fund did with respect to China. China's dollar GDP forecast was nearly $1 trillion higher in the October edition of the World Economic Outlook. So according to the fund, China would have a nominal GDP of $25 trillion by 2026, whereas India would struggle to reach $5 trillion. The bulk of it is because of the fund's assumption that India's inflation rate will be higher than what it assumed in April, and therefore the Indian rupee will depreciate by about 3 to 4% per annum in the next 5 years against the US dollar. But this is where I feel the fund may turn out to be wrong. I hope so. I mean, you can't be sure, of course, because the inflation rate in the West will turn out to be more persistent. I understand that now the Fed is abandoning the adherence to the word transitory. The recent rhetoric does tell us that the Federal Reserve seems poised to undertake some kind of a tapering of the bond purchases, to be followed by monetary policy normalization. However, I would argue that the Federal Reserve will not be able to sustain any normalization of monetary policy beyond a quarter or two. Because right now, post-2008, post-2020, the United States economy and the financial markets have become a house of cards. It's built on debt. Just like Japan, the United States can no longer handle higher interest rate. In the last cycle, Mr. Powell took it to 2.5% by 2018 end before he reversed course. This time, I'll be very, very surprised if he is able to take monetary federal funds rate beyond 1% before he is forced to abruptly do a 180-degree turn. And therefore, I would argue that in the medium run, the Indian rupee will repeat its performance of the first decade of the new millennium rather than the second decade's performance. And China, on its part, will definitely have to face the backlash coming from the real estate sector slowdown, supply chain bottlenecks, and the overall sense of isolation that is creeping up between China's ambitions and goals and what the West is willing to allow them space for. So therefore, I would argue that India's potential GDP growth, which was reckoned at between 7 and 8% way back in 2017-18, the fund has now lowered it to 6%. I had explained to you in detail that much of the slowdown was due to one-off factors in 2018 and 19. Once they dissipate, I expect the potential GDP to go back to 7%. I'm surprised that the fund has even lowered historical potential growth estimate in its recent World Economic Outlook. So there seems to be a considerable level of pessimism about India's GDP growth, which on the basis of some of the nascent developments, I find them somewhat excessive. Of course, many of us are familiar with this chart. China's nominal GDP heading towards $15 trillion. India has not yet crossed $3 trillion because of the rupee depreciation and the 3% nominal GDP contraction in 2020-21. However, if you scale China's GDP or adjust China's GDP by the amount of debt, non-financial sector debt, excluding banking, and India's GDP by India's non-financial sector debt, all in dollar terms, the Indian line, which is the orange color saffron line, lies above the Chinese line. The point here is that much of China's GDP increase, which started in 2005, driving a much bigger wedge between India and China, was driven by debt. So if you take the 40 years of China's economic reforms, clearly much of the success story was built on the 25 years of reforms, whether it is the rural sector reforms, agricultural liberalization, town and village enterprises, state sector restructuring, etc., and WTO membership. But post 2005, and especially after 2008, and again after 2013, after the presidency changed hands, much of the growth has been driven by real estate sector financed by loans. That is why the quality of China's GDP growth has come down so much, and it will have a hard time maintaining the growth rate that the fund is projecting going forward. So we can be a little bit more optimistic that the government, having conserved its fiscal energies in the last 2 years, has more room to expand debt-based infrastructure spending, and so will be the private sector after 10 years of repairing its balance sheet. So India has now the ability to leverage as it did in 2003 to 2010. But the only thing we need to watch out for is India should not repeat the mistake that it did between 2010 and 2013, which is to keep the fiscal and monetary policy simultaneously loose. RBI's balance sheet as a percentage of GDP has been rising, while the Federal Reserve has definitely overtaken the RBI in recent years, post 2020, but RBI's balance sheet too has expanded. So there may come a time, not for reasons of inflation, but for the reasons of avoiding overheating, current account deficit, credit boom, asset misallocation boom, etc. For these things to be avoided, a policy of restraint has to come in place sometime in the course of 22-23 when it comes to RBI. And that is where the biggest test will come for the current governor, who has done the last 3 years exceedingly well. So he has to now to be able to withdraw the punch bowl rather, and that will be an unpopular step, but he has to show that he is made of a sterner stuff as we head into 2022. And he also should keep an eye, more than the inflation rate, I would simply say the Monetary Policy Committee must keep an eye on this number. What is this number? This is basically the percentage of the RBI household inflation survey respondents who expect double-digit inflation rate in the next 12 months. This chart shows you that historically in the last 12 years, when the survey has been done, more than 50% always anticipate double-digit inflation rate in the next 12 months or more. Stung by the experience of 2009 to 14, Indian public expects double-digit inflation by and large. But once this number crosses sustainably above 50%, then the time will come for monetary policy to apply the brakes on liquidity and low interest rates. Right now, it is not flashing a red signal. Summing up, I would say, so given seroprevalence in India, hopefully the T cells and the acquired immunity are able to withstand Omicron. Omicron should not derail India's recovery in a big way. That is my current assumption, but it all depends on what we discover in the next 2 weeks. I think personally, Europe is more vulnerable than any other region in the world to the new variant. And to the extent that the developed world gets affected by this, and asset markets actually begin to become risk averse in the developed world, I would think it is actually for India's good, because India can do with a little bit of moderation in risk appetite in asset markets, and it will also keep a lid on the oil price. And therefore, in many respects, if economic animal spirits begin to look a bit weaker in the West, it will actually play to India's advantage in terms of removing the overheating concerns and also moderating the oil price and commodity prices, and also the Indian stock market, making it more durable for longer. So that will be actually a good thing. So in that sense, you could even argue Omicron-induced risk aversion might turn out to be towards India's advantage. India's monetary policy dilemma will be greatly resolved. Formula repeal at the moment doesn't look like a major reform setback. The door has been left open for it to come back in a different garb. Capital investment cycle and real growth rate rising above 7% from 22-23 or 23-24 onwards are distinct possibilities. Market correction is a short-term risk, and that should be welcomed actually, because it will make it more durable. Medium-term risks for the world are green transition, including for India, and repeat of the policy errors of 2010 to 12. So I would leave it there because I have crossed my 25 minutes time limit. But however, if there are questions on the rest of the world as well, I can cover them as part of the Q&A. So therefore, I conclude my presentation here. Thank you very much.
We have one question from my colleague Pratik Gadia in Almus. After years of single-digit inflation, why very high proportion of people still expecting a double-digit inflation? Even though you answered it, I would like to hear from you again.
No, I think it's, the important thing to realize is that, I don't know whether your colleague is aware that there is a recent paper by the Federal Reserve economist who also says people's inflation expectations are driven by their experience at the pump, at the petrol pump, and in their supermarket. The same thing was discovered in the case of New Zealand, one of the first countries to do the inflation targeting policy from 1989 onwards. So it is not a surprise that what people perceive or what they are experiencing on a regular basis, which is food and energy, and not what the index tells them. And then 5 years of consecutive double-digit inflation will definitely have a longer-term scar rather than what the financial markets are familiar with. Inflation targeting, overall CPI index, core index. That is all for the people who do analyzing, not who actually do shopping.
Another question, I will stop with last third question. This question is, what is your view on interest rate if the Capex is on rise, and how will liquidity be made available to the MSME for Capex?
Usually, it is very clear that Capex is not driven only by interest rates. In fact, if you look at historical evidence globally, profitability drives Capex decisions by firms, and therefore the outlook for demand. And that is where I spend time saying some of the special one-off factors that held back growth in 1819 and 1920, once they are removed, you will have 6 to 6.5% GDP growth regardless. The question is whether we go towards 7 to 8. So once businesses see that we are back to a sustainable 6+% GDP growth with profitability and extremely low tax rates at the moment, etc., then businesses will be able to invest. After all, interest rates were reasonably high between 2003 and 2008. The currency was strengthening, yet export growth was more than 20% every year in the 2003 to 8 period. So ultimately, what matters is the overall demand outlook for profitability, rather than interest rates. So even if policy rates move up by 50 to 100 basis points the next 12 to 15 months, that will not derail the capital investment cycle.
The last question is from my side, which I repeat that Maulik told in his opening remarks, welcome speech, that we feel the financial markets in India is incomplete. Even Dr. Rajeshwari Sengupta also said, any market to develop, the financial market to develop, is criteria important, and it's a brain of economic growth. where do you see we see about 5 trillion economy and all. What is that lacking? We definitely feel it is lacking, incomplete for companies and corporations and to individuals like you and me also.
I'm not entirely sure I understand the question fully, but let me try and answer to the extent I understand. As we head towards 5 trillion, whether our financial markets are complete or not. I mean, parts of India's financial markets have developed on par with economies which have a GDP of more than 10, 15 trillion, but parts of the Indian financial markets are not developed at all and more commensurate with where we are between 2.8 and $3 trillion. It is precisely the access to finance for medium and small enterprises, or for that matter, the absence of a corporate bond market that many would have had in mind when they talk about incomplete financial markets. But having said that, Germany and Japan and many European countries grew on the back of the strength of bank financing. I am yet to see an empirically rigorous study that shows that countries had a step up growth rate in the real economy and in their capital investment after they had a developed corporate bond market. I've asked many people, I'm yet to see a study that actually makes this point that a corporate bond market is a sine qua non or a prerequisite for a country to become a developed economy. It isn't. So all that matters for India's financial markets to become complete is in terms of enabling access to micro, small, and medium enterprises. And there again, I think we have made considerable progress in the last several years because of digitization, because of the continued attempt at formalization. So I mean, for example, the recently announced account aggregator framework, and even the trades, all these things are at the moment probably haven't made enough progress as we think they should have. But I think they are making us, we have made a start, and several state governments are getting into the act. And that is where I said the public procurement rules being tweaked to ensure that the government pays 75% of the contractual obligation within 10 days matters. The GEMS market, the government e-procurement market, is automatically linked to the trade receivable platform. These are all the small building blocks which will take us towards complete markets. But having said that, a financial market development normally follows economic development. And in cases where it has preceded economic development, it has resulted in a crisis. And the classic example is the Asian crisis of 97-98.
Brilliant. That was a brilliant answer. And you are considered as a very optimistic economist and pro-growth and all. It's a pleasure to listen to you, Dr. V. Anantha Nageswaran, again, second year. We look forward to listen to you more. And I have an announcement to make. We have a similar enriching session on day 2, and day 2 starts at 9 o'clock. So I would not take much time summing up. I don't want to extend this session. What I will do is opening remark of tomorrow's session will be by me only. I will add something and cover up that. And here we have already reached 7 o'clock. Thank you very much. Thank you, Dr. V. Anantha Nageswaran. Thank you all the participants. Thank you all the speakers of the day. With this, I conclude and looking forward all of you to log in at 8:45 tomorrow morning. Thank you, sir.